What happens when the house prices rise through the roof? They collapse, because unfortunately that's how they work. Last year, house prices increased by double digits. If you compare that to other assets such as stocks, that might not seem high. However, a double-digit rise in real estate prices is a sign of a bubble. The housing market didn't emerge yesterday like cryptocurrencies. It's a well-established market that grows by around 2% annually to catch up with inflation. However, when prices started rising slightly faster as they did in 2008, they crashed. With such a low interest rates, it was not easy to sit aside and not take a mortgage or at least refinance your house, because even a 1% difference in your mortgage rate is going to make a huge difference in the long run. Let's say rates do rise by a full 1% by the end of the year. How much does a 1% difference in a mortgage is going to make? If your loan is $200,000, a 1% difference means you will pay an additional $36,000 over 30 years. That's a lot of money if you ask me. And we did not even take into account the opportunity cost of that money, which means how much that money would have grown if you have invested it. A 1% difference on a $200,000 loan equals an additional $239, which equals $518,000 if you invested in the S&P 500 for 30 years, assuming you will get a 10% rate of return in the long run. Imagine if you negotiate and get a slightly lower rate. You will end up with an extra $500,000 when you retire. I think that's something worth considering. But what if your mortgage is $300,000 or $400,000? That number would be significantly higher. If you borrow $400,000, you will pay an additional $71,870 in interest over 30 years, or $477 every month. If you count the opportunity cost, it would equal to over $1 million. That's why whenever you take a mortgage, the number one thing you should pay attention to is your mortgage rate. So when the Fed lowered interest rates to almost 0%, everyone who had the opportunity to get a mortgage did actually take a mortgage, which led real estate prices to rise significantly in the middle of a pandemic. Real estate prices didn't just rise, but they rose faster than income, which means fewer people can afford a house now. But because mortgage rates were so low, it still made economic sense to buy a house. But what happens when mortgage rates will rise? Which eventually will happen. The demand will significantly slow down, which will cause real estate prices to crash. Another factor that we have to consider is rent prices. Usually, rent prices go hand in hand with house prices. Sometimes one grows faster than the other, but not by a huge difference like it happened last year, which led many experts to believe that we might be repeating the same path as we did in 2008. If the Fed didn't intervene last year, then we definitely would have had a real estate collapse, since most people wouldn't be able to pay off their mortgages. Most people live paycheck to paycheck, and the only reason they qualified for that mortgage is because they had a constant stream of income. But when millions of people suddenly can't make their monthly payments, the bank will freak out and start selling these homes to make up the payments. But that means there will be an oversupply of houses in the market, which will drive the price down, which will crush the market. The US has already experienced that. Therefore, the government said, listen guys, you can take a 1-year break from your mortgage payments, even if you can afford it. That was the main reason why the market didn't collapse. But what happens when the forbearance period is over and the economy hasn't entirely recovered? When people have to make their mortgage payments, but they don't have the financial ability to do that, the pyramid will finally collapse, especially since prices were rising faster than ever, and that creates the expectation of future rise. That expectation attracts speculators who invest in the market, hoping to profit from the rising prices. This further increases demand and prices, causing the bubble to stretch and grow. And on one beautiful day, it is going to burst. In 2008, mortgages were not regulated much, so banks started giving loans randomly. I'm not saying that sarcastically, but that's literally what happened. Mortgage underwriting got so sloppy during the housing bubble that some lenders were giving out ninja loans. No income verification, no job verification, absolutely nothing. On the other side, developers were building houses faster than the US population could occupy them. It took a while, but eventually prices plunged. People defaulted on their mortgages, and the US economy crashed, helping to bring down the global economy with it. When values crashed, some of these homeowners were unable to keep making payments, and they couldn't sell the home for the amount they owed. Banks didn't care much, since they would take these mortgages, bundle them together, and sell them to investors in the form of securities. That's why these banks kept calling people to convince them to take a mortgage and didn't even require them to provide any documentation. It made sense because everyone thought that home prices will always rise. Isn't that what your parents told you? However, the unexpected happened. If you give it a closer look, the housing market today is nothing like in the 2000s. No one is getting a mortgage unless they can prove that they can pay it off. Secondly, the homeowner vacancy rate is 0.9%, the lowest in the US since 1956. In other words, there is a shortage of houses this time, not an excess. And when there is a shortage of supply in the market, the prices naturally rise. Since the 2008 crash, home builders were very careful because the banks are heavily regulated since then, so there was no point to keep building new houses unless there is a clear demand for them. No one expected that suddenly there is going to be a pandemic and the Fed will lower interest rates to 0% and mortgage rates would plummet to the bare minimum. Remember at the beginning of the video where we talked about how big of a difference does a single percentage makes in the long run? That's why so many people jumped in to buy a house. So even though home prices rose significantly, smaller mortgage payments still attracted buyers. However, we also have to consider that 1 in 10 homeowners with a mortgage is behind on payments, according to the US Department of Agriculture, which could lead them to default on their loan. Of course, the forbearance program is going to be extended, but even if it's not, most homeowners have accumulated substantial equity in their homes, so they could sell them and pay off their mortgages in full with no sweat, which wasn't the case in 2008, when the fall in prices caught people off guard with big mortgages and little to no equity at all. What's going to happen to real estate market is entirely based on how well the Fed is going to manage it. If the Fed carefully lowers interest rates, there might not be any crash, except that prices will stop rising or might experience a small decline, but there won't be anything close to a crash. We also have to understand that the real estate market is not like the stock market that moves up and down every single day. It's a well-established market that moves extremely slowly, and if anything like a crash is on the horizon, it is definitely not happening this year. No one knows the future, of course, and I could be entirely wrong. But since we have recently came out of a real estate crisis, it's difficult to imagine that another one is on the horizon less than 2 decades later. Meanwhile, if you have a mortgage and you haven't refinanced it yet, then you're missing an opportunity, because getting a lower fixed rate for 30 years is the best thing you can wish for. No matter what happens to the market, even those who didn't sell their houses back in 2008 still saw their houses rise in value over time. So anyone who got a low fixed 30-year-old mortgage rate should be fine in the long run. By the way, we have made a video on why everyone should invest in real estate on our second channel, where we have explored the hidden benefits of investing in real estate. Please go and check it out and make sure you subscribe to the channel. And now give this video a thumbs up if you have enjoyed it, and subscribe if you're new around here. Thanks for watching, and I will see you in the next one.